All right, let's dive right into this explainer. Today, we are looking at a huge financial contradiction surrounding Ares management, specifically as of Q2 2026. On paper, it's a flawless execution machine, right? But dig into how the market's actually pricing it and a total mystery pops up. First off, let's just talk about the sheer scale of what we're dealing with here.
Ares is just an absolute behemoth in the financial world. We're talking a staggering $671 billion in assets under management. Nope, not a typo. That is a massive, massive pool of capital they've been entrusted to oversee across their alternative investment strategies.
And they definitely know exactly how to monetize that capital. Just in one single quarter, Q2 2026, this giant cranked out $491.1 million in fee-related earnings. It really proves their asset base isn't just sitting idle. It's actively generating highly lucrative recurring revenue for the firm.
Plus, the momentum is just not slowing down. They recently pulled in massive inflows, over $36 billion in one quarter. Basically, their fundraising machine is operating at record levels, bringing in institutional capital at a genuinely breathtaking pace.
And to top it all off, shareholders are absolutely getting a piece of the pie. They're being rewarded with a confirmed $1.35 quarterly dividend, which translates to an annualized $5.40. So let's recap. Massive scale, incredible earnings, record fundraising, and a really healthy dividend.
But hey, here's where the mystery really kicks in. With all that undeniable success, why on earth is the market demanding an astronomical 63.5 times price-to-earnings ratio for this stock? I mean, that's not how you normally value a traditional, mature financial firm. That's the kind of multiple you'd expect to see attached to a high-flying tech company.
Which leads us straight to the core question of our explainer today. Is the market correctly pricing an extraordinary growth company that'll eventually grow into this huge valuation, or has investor optimism just gone way too far? To solve this whole puzzle, we've got to look past that attractive dividend and dig into the actual mechanics of what Ares sells.
So it all comes down to their brilliantly simple flywheel. As an alternative asset manager across credit, real estate, infrastructure, and private equity, it works like this. First, investors provide the capital. Second, Ares actively manages it. And third, Ares earns management fees and other economics. It's simple, right? When performance and fundraising stay strong, that flywheel just spins faster and faster, and the economics get extremely powerful.
But having capital isn't exactly the same as deploying it. Right now, they're sitting on $170 billion in uncalled capital. Good old dry powder. It's a massive war chest for sure, but it raises a pretty critical question for anyone analyzing the firm. Can Ares actually turn all this uncalled capital into future earnings? Because at the end of the day, capital only generates maximum fees when it's actively put to work.
And to figure out how well they do that, you've got to know the professional secret of looking at the right metrics. If you just glance at the Q2 2026 GAAP net income of $150.6 million, you'll honestly completely misunderstand the company. The pros focus heavily on that $491.1 million in fee-related earnings, along with the $467.6 million in realized income. Looking at those numbers strips away all the accounting noise and reveals the platform's real cash-generating economics.
Which brings us back to that dividend we mentioned earlier. An intermediate investor might easily get distracted by the recent 20% hike, jumping from $1.1250 to $1.35 a quarter. But we need to look closer and uncover the actual growth engine keeping this machine running. The dividend? That's just the visible reward. It is not the engine itself.
So, what is the engine? Well, future fee generation basically relies on 6 key pillars. You've got attracting new capital to drive AUM growth, converting that into actual fee-paying AUM, relentless fundraising, putting that capital to work through active deployment, maintaining strong investment performance so clients stay on board, and finally, product expansion so they aren't totally reliant on just one strategy.
Now, a huge piece of this specific growth story is private credit, driven by an astonishing $52.3 billion in U.S. direct lending commitments. That is across 347 transactions just in the 12 months ending June 30, 2026. Ares isn't just along for the ride in the private credit boom, they're literally one of the dominant architects of it.
But of course, a credit opportunity this big also introduces some major risks. Think of it like a potential domino effect. If higher interest rates or a weak economy start pressuring borrowers, those companies are going to struggle to service their debt. And when borrowers struggle, defaults inevitably go up. Once defaults rise, credit losses hit the firm's investment performance, and that can eventually completely choke off their ability to fundraise. Now, to be clear, Aris is absolutely not in a crisis today. Far from it. Their fundamentals look incredibly strong right now. But as sophisticated investors, we've got to ask, what happens to that premium 63.5 PE valuation if private market activity actually weakens? What happens if the credit cycle suddenly turns against the industry? Because a valuation that high, it leaves very little room for error.
So this leaves us looking at two potential futures. First up, scenario A, growth wins, and their expanding AUM completely justifies that premium valuation over time.
Or we have scenario B, expectations win, which really just proves that a genuinely great company can still be an incredibly expensive stock.
Let's break down the psychology here. At its current price of $141.25, a beginner looks at it, sees an attractive 3.82% yield, and just thinks, awesome, I'll take it. But a pro is looking at the exact same stock and obsessing over a totally different question: just how much future perfection and flawless execution is already baked into that $141.25 price tag.
So, wrapping all the data from our explainer together, what's the final verdict? Well, since investors are currently paying a massive premium for future growth, indicated by a 2.13 PEG ratio, the most disciplined move really depends on who you are. If you already hold it, it's a solid hold and watch. For a new investor, honestly, the wisest move is to wait for a better valuation rather than just blindly chasing the momentum. Income folks should watch carefully, while growth and high-risk investors might find some selective or speculative opportunities if they're willing to accept the risk of multiple compression.
The crucial takeaway here isn't whether Ares management can grow. They've already proven beyond a shadow of a doubt that they can gather assets and generate massive fees. But listen, when you're paying 63.5 times earnings, being right about the company just isn't enough. You also have to be right about the price. You've got to ask yourself, exactly how much of tomorrow's growth are you paying for today?
Ultimately, Ares is an absolute masterclass in execution, but only time's going to tell if it can actually outrun its own sky-high expectations. Now, what's really fascinating is that the next stock in our investigation has a completely different problem entirely. So stick around, and we'll see you next time as we dive right into that one.